Good morning. So here is what I'm looking at for the short term. Now, the general gist that I'm trying to get out of that little blog post is that in the short term, well, the long term's still pretty good, but in the short term, you're probably, if you want to buy now, you're probably buying above the average price. Now, why is that? Let me show you. It just seems that there's more risk right now than there is reward. So on the top graph here, I have the S&P 500 index, and then on the bottom here, I have my proprietary indicator, which is my short-term money inflow oscillator. So this measures money inflow and essentially short-term demand for stocks. Now, what this indicator down here tends to do is it tends to lead short-term tops. So for instance, what you can look at is, well, this one right here, unfortunately, because of this climax day, was a bad signal. However, we can see that this this small upward track here was also marked by a downward trend in the money inflow oscillator, and then we finally got our kick in the pants right here, which turned out to be a very short correction. As soon as that happened, the market started going up again, and then again you can see once again here we're going up, 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 and then the short-term inflow oscillator tops on 1121, which is right here. And then we continued to make new highs for a couple days after, and then once again descended into a correction. And as the market again tried to make a new high in early to mid-December, the inflow oscillator was still trending lower, which was telling you that this was a fake out. It wasn't until you had this mid-December bottom, followed by this rally, which was confirmed by the inflow oscillator, that things started to look good. And then once again, it started diverging starting on the 27th of December, which was right here. The market continued to prance around its most recent high, and this kept trending lower, saying that in the short term, people were not putting money into stocks, and more than likely they were pulling money out of stocks. And then, of course, we got our correction right here. So where does this lead to us? Where does this lead to now, today? Well, on February 5th, which coincided with very closely to this low here, we got an oversold reading, which is any reading below 40, and this one was at 37. Sorry, I have the axis hidden. However, after that, the price confirmed it went higher. The indicator confirmed it went higher, and it kept going up until the 18th of February, which corresponds to this point right here. And then it tried to meet that high again on the 20th, which was right here. But since then, the S&P has gone up another 40 points, and the short-term money inflow has been really lagging, and it's been going down, where now it's at 57, where it topped out around 66. So what that's telling me is that, one, you're not seeing as much demand pushing up prices in the short term. The long-term picture is still fine. But that means that if you're trying to buy right now, if you're doing broad-based buying with intent to maybe do a swing trade for a couple weeks, you're probably buying at a relatively high price. And I'm just thinking that while this divergence can last maybe another week or two, you're still exposing yourself to some risks that you wouldn't have had when the indicator was down here in the high 30s or the low 40s at these points. So all I'm saying is be careful. Short term, it looks iffy, but once again, long term looks fine. So that's what I'm trying to get across today, and we'll see how it plays out. So make sure to stop back soon, and I'll keep you updated. Thanks.